All right, guys, welcome back to episode 3 of the Risk On podcast with Arbitrage Andy, where we cover markets, geopolitics, and society without the fluff of legacy media. Today, we have a very special guest, Joshua Young. Josh is a seasoned investor with over 15 years of experience in investment management, including a decade of specialization in oil and gas securities. He studied economics at the University of Chicago, graduating with honors with a focus on history and econometrics. He's also the founder and current CIO of Bison Interests, a Houston-based investment firm, as well as the former chairman of the Board of RMP Energy, which he helped transform and rebrand into Arbitrage Resources, eventually leading to a successful buyout at a 78% premium. Josh, appreciate you joining us today.
Yeah, thanks for having me, and thanks for mentioning the Arbitrage thing. That was it makes me look a little more seasoned. I think it was 2 years that made me 10 years older.
Absolutely, yeah. We'll definitely get into that. I know some of the listeners want to hear about some of the intricacies of that deal in particular, but you've had an impressive career in investment management, focused on oil and gas. I'm excited to dive into your insights on what's happening across the world, deep value investing, the intersection of a lot of the geopolitical events that we've seen in the financial world and across the globe recently. You and I have interacted a little bit on Twitter. I do read your Substack. One thing that I've been able to glean from you is that you put a high value on honesty, which is a rare trait these days. I would also say that depending on who you're talking to, it can also be considered an unpopular thing. What do you kind of have to say to that?
Yeah, I think integrity is sort of integrity and trust are things that take years or decades to sort of build in terms of your reputation and trust, and can go away in a second. And so I think there's a balance where you can't do things if you have fiduciary obligations. You can't do things that hurt your clients or hurt some other sort of legal or moral obligations. But otherwise, I think you got to just be honest and open. And I try to be careful. Even though we were talking, I think I have almost 100,000 followers now on Twitter or X, which is just stunning. Like,
crazy.
I only started posting in 2020 there, but yeah, super important. And where I draw the line there is just I try to have like great conversations. It's really helpful for me in terms of assessing sentiment and doing research and other stuff.
Sure.
But when people behave in bad faith, I think that's sort of where it makes sense to sort of cut them off. And integrity, I think, is your highest value and the most important thing.
It's refreshing to hear for sure. So I've done my basic research. Can we talk a little bit about how you first got into investing? I know you've mentioned before that you kind of started out with the physical edition of the Motley Fool, if I'm not correct, and I guess more specifically energy. What initially attracted you to that?
Yeah, so I have a few touch points with the Motley Fool, which is funny because I've never actually written for them. I've met some of the folks that
Okay.
sort of helped get it started. So yeah, I used to read the newspaper when I was a little kid. I was real cool. So
Yeah.
I would read the LA Times cover to cover growing up in Santa Monica. Um,
Nice.
and, I liked the comics section when I was really little. And then I started to like, the local news was always super interesting because they had crazy stories. And then the business news, and I love the Motley Fool column. And, with some money I got from my bar mitzvah when I was 13, sort of, I think, classic Jewish finance story, started investing in stocks, a lot of which I'd get the idea from the Motley Fool or from other sort of similar things. And, really it started from there.
Yeah. Yeah. That's awesome. Yeah. You've obviously been doing this for a while, I think, and I don't know if you would agree, but I think it's very helpful when you have that initial spark of interest, and as soon as you start immersing yourself within it, whether it's stock pitches, whether it's just reading, maybe you're trading on a paper account, I think that's pretty, I would say a pretty important piece of eventually, you know, becoming somewhat of an expert in that realm. You really do just need to kind of fully immerse yourself in it. At least that's been my experience.
Yeah. I mean, it was super weird because so I went to the University of Chicago and studied economics, and all of my econ professors told me about how I couldn't pursue finance or shouldn't pursue finance as a career. Definitely not investing in public equities.
Huh.
But ironically, it turns out some of them were involved with DFA and
Sure.
FAMA's various things, and so they were telling everyone not to do it. You couldn't earn any money, while at the same time, they were like working or advising on this giant hedge fund and giant investment advisors and stuff. So I think I probably would have pursued a little more direct route into finance if I hadn't been sort of advised repeatedly to just there was no alpha, there you couldn't beat the market, whatever. As these guys were actively doing that, but yeah, I mean, I love investing, but just like anything, nothing's perfect, and I think having big losses early on and big
Yeah.
disappointments over time are really helpful in terms of being able to build the intellectual honesty and the emotional fortitude to be able to deal with the vagaries that the stock market will give you.
Yeah. Yeah. That makes sense. So I looked it up on your website. Bison Interests. Can you maybe share with the listeners how that name origin came to be and maybe what it represents?
Sure, and just like a very brief disclaimer, none of this is an
Of
offer,
course.
solicitation, no recommendations or anything like that. This is purely just meant to be an educational conversation
Sure.
and trying to help support your podcast. So
Yeah, absolutely. Of course. Not financial advice.
exactly. So Bison, I actually co-founded, and my co-founder, who's no longer with Bison, who's with it for the first 5 years, he helped come up with the name. And Bison is the only animal that, when there's a storm, it faces into the storm to get through it safer and faster. And so we knew in 2015, launching Bison to invest in publicly traded oil and gas, people hated oil and gas because oil prices just crashed, and most people that were involved lost some or most of their money in the
Yeah.
sector. And then there was a bubble in oil and gas private equity at the time, and private credit. And so this idea of going and intentionally starting an investment firm to invest in publicly traded oil and gas stocks, we were facing right into the storm, and so we felt like the Bison name was really appropriate.
I I like it. I don't know if you saw this. A baby white bison was actually born in Yellowstone. I think it was in April of last year. No, April of this year. And according to Lakota, the Lakota tribe prophecy, it is a symbol of better times and great change. So I'm not sure if that means you guys are going to have a killer year, but I figured I'd mention that.
That'd be great. Starting now for the rest of the year, we'll take it. White Bison, that's where it's at.
Absolutely. As someone who's specialized in publicly traded oil and gas securities, how do you evaluate investment opportunities differently than, say, traditional energy investors who might focus more on private equity or venture capital?
It's a really good question. It's almost like a different activity where you're still running the equivalent of DCF models and sort of considering what liquidation values are and considering sort of how much cash flow can come out of the businesses at various prices. So and reinvestment opportunities and rates of return, and oil price and gas price break evens and so on. So you're doing some of the same stuff, but the output looks really different and the timeframes look really different,
Mhm.
where you have a lot more time and a lot more information on the private side, but the discounts on the public side can be more extreme, and the repricing can also be more extreme. So there's sort of trade-offs between the two, and oil and gas private equity has done a lot better than public equity. I think partly in the last decade, partly because of governance, but also because without sort of that need to sort of worry about quarterly returns and quarterly performance or day-to-day performance, the private companies, I think, have been able to better focus on earning compounded returns. That being said, I think sort of going forward, especially on the sort of similar size companies on the public side, with it being so unpopular, I think there's room for the public equities to materially outperform over the next number of years.
Sure. So so in 2021, the fund had, I think, net of fees, roughly a 350% return. That's obviously incredible. In that year, I'm curious, was there a specific concentration within the strategy that was able to yield that result? Did you guys have a few stocks that really just were home runs? If you can recall, what exactly led to that performance that year?
Yeah, so I think the biggest thing, and I'll try to share this sort of high level so that it doesn't sort of lose people in the details. It wasn't any one particular company or any one sort of particular type of investment. It certainly wasn't through leverage or anything like that. What we had going on was we owned oil and gas producers that were making most of their money on oil, and natural gas prices have basically been destroyed. Not just the overall price for natural gas, but you sometimes get a much lower or a much higher price for oil or for gas, depending on where your field is and how close it is to where people actually need the commodity, and if the
Mhm.
local market is undersupplied or oversupplied. And so during COVID, there were real big shifts in natural gas supply, and so fields that we had exposure to where we owned them for the oil production ended up actually producing a ton of cash flow on the natural gas side. So we like bought at a discount to the oil value and got the gas for free. And in 2021, with the energy crisis in Europe, with various other
Yeah.
things, with local natural gas prices ripping, with a hurricane or sorry, a winter storm in Houston,
Yeah.
that ended up with just this spectacular upside. It's sort of this idea that when you're in business, you can get T. Boone called it. I think I'm going to mispronounce it, but lanyap. Basically, like you can get lucky, but you get lucky by being in the business.
Yeah.
And so we suffered previously from low natural gas prices, and even though we owned these things for oil, we sort of got this benefit of being in these value stocks where they got this extra uplift from natural gas. So that was where I think the bulk of the extra return came from.
Yeah, I mean that's obviously an incredible year. A lot of changes in the industry, a lot of volatility since. I've read that you're not necessarily, or at least historically, you haven't necessarily been focused on a hurdle rate, but more so on outperforming competitors and maybe outperforming oil and gas stocks more broadly. Is that still a core pillar of your strategy and philosophy, particularly this year?
Yeah, I mean, look, like we're down this year and we're underperforming energy indexes a little. So on that basis, we're doing terrible. And I think there's just sort of a reality, which is that you're never as smart as people think when you're just doing extraordinary, and you're never as dumb or as bad or whatever as people
Yeah.
think when you're doing poorly. And so, while I don't think that 350% net year or 349 or whatever net year in 2021 was indicative, I also don't think 2024 is indicative. I think
Hmm.
there's sort of this blend over time where you earn a compounded return. And I think what I meant by that was a little more along the lines of not trying to index hug, not trying to
Sure.
performance chase in the short term, and being more oriented towards compounding returns over time, and being really careful not to sacrifice sort of the balance of potential upside, and at the same time not taking too much risk at the portfolio level to end up at a potential material impaired capital situation. So it's sort of a balance between trying to do better than the energy sector over time, but
Hmm.
also I do think the energy sector ends up outperforming the market after underperforming for so many years. And so I think we sort of want that beta, sort of the market performance, to help us in energy, as well as our stock picking outperformance, which we've experienced. It's pretty cool. I mean, I'll say, this year we're underperforming the energy indexes, but especially the small cap one, which we benchmark against significantly. But since we started, that energy index is down about 60%, and we're up about 80%, plus or minus a little, net of fees, net of expenses, whatever. So that sort of outperformance, that's an absolute number. That sort of outperformance is sort of very, very hard to find, especially when you don't short stocks, aren't using leverage, and so on. And so, hopefully, we're able to extend that sort of outperformance while also, over time, ultimately beating the market by quite a bit. So, I guess I'm sort of aiming for both. And so, very disappointed this year, both losing money and
Sure.
underperforming the index, but also, if we didn't do that, sometimes we'd be cheating, right? Like, I don't think
Yeah.
it's really possible to always win. And we try as hard as we can, but there's also, I think, some reality. And I'm excited. I think we're set up for some great things. I just don't know if that's tomorrow or next week, or hey, the white bison means maybe we're gonna start winning this year.
Yeah, hopefully the white bison prints. Yeah, I mean you can't miss the wood for the trees, right? That makes sense. As an energy focused investor, obviously these have been an insane 2-3 years we've had. when I look at the kind of geopolitical events, the global landscape, which specific opportunities or geopolitical risks are you looking at the moment? I know we have natural gas pipeline capacity from the Permian Basin is set to increase. I believe that production has doubled roughly since 2018. You've got Matterhorn, Apex, Blackcomb. I think Saguaro is coming online in 2027. That's led to reduced spot prices, potentially need to export some of that to more viable markets. That's close to you in Houston. You've got Hurricane Francine. There's a lot of noise. What specifically are you focused on at the moment?
So I think we're set up potentially to have another year. And again, maybe it's later this year, maybe it's next year, maybe it's in 2026. And again, the outperformance was so extraordinary, I sort of
Mhm.
don't mind waiting for it and looking like an idiot in the meantime. I think we're set up for another year like 2021 where we have these same, in some cases it's actually the same stocks, in other cases it's similar positions, but same idea, where we have these things that have they look terrible because their cash flows are down a lot because they have exposure to natural gas, even if they're mostly oil producers and their cash flows mostly from oil. And people look at them, and I think both qualitative sort of investors, fund managers, as well as I think sort of the quants and the various computers looking at this stuff and just sort of automatically shorting or whatever. And then
Mhm.
also technical traders, they look at this stuff and they say, "Wow, these companies and these assets are terrible
Yeah.
because the oil's flat." Or down slightly, and their cash flows are down a lot. Therefore, they're terrible, and therefore they must be degrading. And they're on social media. They'll call it like a shit co or terrible
Yeah.
companies or poorly run, whatever. And the reality is, some companies and some assets are like that. But if your cash flows are down a lot because your local realized price is down and the overall natural gas price is down, and like you said, you have pipelines getting built and you have LNG projects progressing.
Right.
Hey, maybe it's a temporary thing, and if your stock is sold off on the back of this sort of perceived degradation in value, what's it look like when suddenly you're making 40% more money or something because you're going from negative $7 an MCF on your gas to positive 2 or positive 4? So that's definitely something I'm
Yeah.
looking for, but I don't see that as like a geopolitical risk or whatever. It's just sort of a shift in local market dynamic.
Sure.
Um, I think on geopolitical risk, I think the big thing, and I've said this publicly, and again, it's one of those things where it's really hard to know when. It's more of a, what are the odds of it happening? I think there's a pretty high chance of a oil supply disruption out of the Middle East, and
Right.
we have rockets still getting shot. As recently, I think a week ago, oil tanker got blown up and was leaking and whatever in the Red Sea. So you have an active situation still there. You have Israel dealing with Gaza, and now very recently they just sent a commando force up into Syria to
Right.
attack Syria and Iran. I think we're just sort of moving towards this situation. It sort of looks like, if you look at history, like
Yeah.
1971 or something like that, where you have this sort of war, but it's not quite gotten to an oil supply disruption. And then everyone was shocked in 1973, but they couldn't look and say, "Hey, wait a second, there's all this stuff happening, that's sort of similar to what happened before for the 67 war." And yeah, in 73, the Arabs surprised Israel instead of Israel surprising the Arabs. Right?
Right.
But it sort of doesn't matter. You just have these sort of things they're not de escalating despite tremendous pressure from the West. I lived in Israel for a year. I have a family
Okay.
and friends there, as well as in other surrounding countries. And I think people are just sort of sleeping on it. And I think that oil supply risk is probably the biggest single left tail risk. Maybe even bigger than the Fed sort of messing up and sort of
Yeah.
raising interest rates too much too quickly.
Yeah. Yeah. I mean, there's chatter at the moment that Russia is supplying missiles to Iran. We have the potential for long range strike inside of Russia by Western arms. Granted, it's not the Middle East, but any of those long range strikes inside of Russia from Ukraine, hopefully not with Western weapons and equipment, but if they are, there's the potential for escalation. One thing I did want to ask you about, and it's a little bit dated at this point, but a lot of information out there about Nordstream. I think the latest is they're alleging that there was some sort of six-man diving crew. They were on a sailing yacht called the Andromeda. The saboteurs had been trained in Poland. If you can kind of think back to that event, I'd be curious to hear from your seat. What were some of your first thoughts as you learned of that news? And I guess, what was your first instinct to hedge depending on the exposure that you had? What were kind of where was your head going in the immediate aftermath of that?
Yeah, so it's funny because I'm too much of a conspiracy theorist for some people, and then not enough of a conspiracy theorist for others. Like
Yeah.
I posted this video on social media recently on of a metal worker explaining the metallurgy of steel and how you don't need jet fuel to get to the
Right.
melting point of steel for steel structural integrity to be altered. So a plane crashing into the World Trade Center clearly was sufficient heat and force to knock it over
Right.
in the way in which it was knocked over. So there are things that are very easily sort of debunked. Um, I mean, one thing that was very easily debunked, if you thought about it for more than a second, is that Russia did not blow up their own pipeline.
Of
And it
course.
didn't matter how many times the Biden administration got on TV and said it, and it didn't matter how many different news reporters and newspapers and whomever said it. It didn't matter how many folks on social media with Ukrainian flags or whatever on their profiles said it. It was just people, if you just approach the world with a Milton Friedman style incentive theory, like people behave according to their economic incentives for the
Right.
most part, it's not complicated. Russia did not blow up their own pipeline. Germany also did not blow up that pipeline because they needed it for their energy, and they were not very happy about it blowing up. So most of the reports were blaming Russia, a few were blaming Germany. It was just nonsense. So how did I respond from an investment perspective? Well, I mean, natural gas stocks had gone up a lot, so I cut some exposure. Clearly, not enough because we are underperforming from our
Yeah.
some of our natural gas. And again, we had exposure mostly just through oil producers that had some natural gas production from a minority of their revenue would come from natural gas, but a large sort of volume amount because the price is so low.
Right.
So sold some, but probably not enough. I don't really know how you trade that though, because you didn't really need the gas through Nordstream for European supply, and LNG shipments were rising, and China was starting to reject shipments and send their LNG to Europe. So I think Europe got really lucky that they didn't have a very cold winter last winter. But I don't know that there was, other than just sort of cutting natural gas exposure, because that was sort of, I think, the blow off top for European natural gas prices
Yeah.
is right around then. But other than that, I didn't really, there wasn't some brilliant trade. And like the idea of like shorting natural gas into that, it sort of makes sense because the price was so high, it was really killing demand.
Yeah.
But that's just not my world. And, there are many famous people who lost all of their money from, Amaranth to that optionsellers.com guy that had that horrible video
Yeah.
apologizing to everyone for losing them 10 times the money that was in their accounts. So I just try to avoid making trades like that.
Yeah. 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 That's interesting. I think it's maybe a good pivot to a different geography, and I've heard you speak to it before. I think the broader consensus right now is global oil demand growth is slowing. I saw a recent statistic: world consumption increased by about 800,000 barrels a day in the first half of this year. If you compare that to the same time period in 2023, that's about a third of the expansion that period saw. And then you've got this phenomena of China and electric vehicles. How do you kind of think about the broader energy market, particularly in relation to China at the moment? I know there's some fairly aggressive forecasts through 2030, but what is your sentiment right now regarding China at the moment?
China's really complicated. And so I think what happened with those demand figures, and I think sort of a reasonable baseline for oil demand growth, is that world oil demand has grown by a little more than 1% a year annually over the last 40 years.
Mhm.
And I guess actually sort of in those first 10 years or so, it might have even grown by sort of 2% or so. And then after demand disruptions, historically, oil demand growth has been more rapid than that 1% as it catches up, and then eventually starts to slow down to that sort of 1 to maybe 2% a year.
Sure.
And so 2023, it looks like the numbers were a little too high. And so what you've seen with China demand growth so far this year, the best I can tell, and again, it's complicated. There are lots of very strongly held views on this, and I
Right.
don't have a strong view on this. I'm just sort of looking at all the different data providers and like watching them fight with each other and try to figure out what's happening.
Yeah.
And the OPEC thinks it's 2 million barrels a day still of demand growth this year, and IEA is like, oh, you guys are wrong, and like they're sort of oddly like directly addressing each other, which is
Yeah.
not
Beefing.
not usual, and not normally how these sorts of like economic data providers or forecasters will approach things. So very contentious. So I think the right way to think about it is just China brought forward some of its demand growth. So they
Okay.
grew by, it looks like, almost 2 million barrels a day last year. And so if they're growing by 500,000 barrels a day this year, maybe they only grew by a million barrels a day last year and they're growing by a million or 1.2 this year. I don't
Yeah.
know. I think you sort of split the difference there. There's no collapse in China, despite sort of this narrative. We keep getting told China is imploding. It's not doing great, but it's not imploding. And some of what people are talking about is like 6 months old, where you had a lull in various economic activity in China, and you're actually seeing things accelerate, sort of similar to the US. Apparently, some of the credit card data and certain other potentially leading indicators of economic activity are actually positive in the US right now,
Right.
along with lower mortgage rates. So we might actually not be having, we might have had a recession, we're coming out of it or something. People don't really know. And again, like the people often feel strongly about this like 2 years later when you had all the economic revisions and can look back, but it's way murkier as it's happening. So I think we want to think about that high level. So China probably still growing their oil demand by about a million barrels a day. That should eventually slow, but I think they're still using about, I think it's 4 barrels of oil per person per year versus the
Okay.
US is using like 13 or somewhere in the 13 to 15 barrels per person per year range. So you could actually see, Vaclav Smil and Alex Epstein and a few other folks have sort of worked through Arjun Murti. These guys have like worked through what Chinese demand would be if they consumed as much as the US did, and then sort of how much is going away because of electric vehicles and stuff. I think Arjun has an estimate that world oil demand, if everyone used as much as the US, would be close to 250 million barrels a day,
Wow. Okay.
versus current 104 plus or minus a little million barrels a day.
Hmm.
So there's a lot of upside there. So even as electric vehicles are rolled out, even as China's economy is suffering, there's still room for a lot of oil demand growth there. But yeah, maybe it'll slow, but you're not seeing zero oil demand growth. You're just seeing, slower, but also weird lag effects from 2023. So it's one of those, it's very complicated. People have very, very strong feelings about it.
Yeah.
And if you go back and sort of smooth it out and take away the Chicken Little sort of panic, sell everything, short everything, and also the folks that are ultra bullish China. I mean, it's a communist country. It's a command and control, central planning, mercantilist. Like
Yeah.
these things do fail. And then just the one last thought on that is that Japan was like that too in the 90s and the 80s. And
Right.
if you look at China from their peak to 5 years after, they actually still grew their oil consumption by almost 30% or so, going to 1995 from the peak of the Nikkei. I think it was in 1988. So you still had significant oil demand growth in Japan, and their per capita oil consumption was way higher than China's currently. So there's still a lot of room for demand growth. I think people are really missing that with oil. And I think it seems political, it seems election year
Yeah.
driven. And also, I think people are right that communism fails and mercantilism fails. It just doesn't quite fail in the way that people are thinking. And there should be a lot more oil consumption anyway over time in China.
Yeah. Yeah. I would say the three narratives, air quote narratives that I'm always a little bit hesitant to jump to conclusions on, or anything related to OPEC, countries moving off the dollar, de-dollarization, and then China for sure in the last 6 months or so. To pivot just a little bit, are you exploring any renewables as a part of your strategy? I know I mentioned to you I have a little bit of experience in that space. I have my own opinions on the space. I think the best way to put it is that it more or less fizzled out, at least compared to how it was 4 or 5 years ago. There was a lot of greenwashing going on, a lot of fraud. I know you've said before it's very low EROI and that you place a higher preference on energy security, and then available low-cost energy for incremental users, as opposed to some of these maybe esoteric ESG virtue signaling kind of narratives that were circling over the last 3-4 years.
Yeah, so I think there's a little difference in between sort of how I invest versus what I'll talk about from an energy policy perspective.
Sure.
But it does happen that in this way they're aligned. Alternative energy investments, for the most part, have been enormously value destroying, and even the ones that were successful or profitable by reselling them to other bigger companies have in many cases been subsequently written down to zero, sort
Yeah.
of validating that bear thesis on them, which fortunately we don't really short stocks anymore, so and haven't been for Bison. So we're not getting squeezed on these things. We're just not participating. I think the low EROI, basically not getting a lot of energy back after spending a lot to build the solar panels or electric vehicles or so on. I think that really plays into the economic returns, and where there
Yeah.
are positive economic returns, they're driven mostly, it looks like, by government subsidies and government sort of regulations and like
Schemes.
quasi markets that the government mandates, like for carbon or what have you, which are sort of fake
Yeah.
markets that are government mandated. And the history of those sorts of things is they're good until they're not. And if you look at the history of sort of carbon pricing, and I mean, it looks like a altcoin where there's ridiculous pump and dumps and craziness. And so I'm happy to not participate in those things. And I prefer businesses that earn a profit independent of any government involvement. And I guess just on this point, people say, oh, oil and gas is so heavily subsidized by the government and so on. But the reality is these companies, when they're successful, pay enormous amounts of money in taxes and
Yeah.
royalties and so on. So that's just a weird, dumb talking point that just displays when people talk about that, they just miss the alternative energy industry has been a net consumer of tax dollars, and the oil and gas industry has been a substantial net provider of tax dollars to the government.
Yeah. Look, not to dwell on Nordstream, but I do find it interesting. You look at a country like Germany, who took their remaining nuclear power plants offline last year. As far as I've been able to tell, there's various cited reasons for that. They cited distrust of technocracy, ecological concerns. Obviously, the Green Party in Germany had a huge push in that. But you see this massive development of renewables in Germany to replace some of those more traditional forms of energy, which for a moment in time looked like it was going to be promising. And then they get hosed when Russia invades Ukraine. Then Nord Stream goes offline, amplifies the problem months later. So it's kind of interesting to look at it, some of the vulnerabilities of depending on that technology.
Yeah,
Um,
I think just one thing on that,
yeah.
and this is where I actually have a little bit of sort of right tail exposure. I have a small sort of risk bucket where I'll take right and left tail exposures, just in case. I mean, COVID was very painful. We lost a lot of money. I didn't think there should have been government shutdowns, and there were, but I saw it as a possibility, and we didn't go buy a bunch of put options on the market or oil or whatever
Yeah.
at that time to our detriment. So one of my takeaways from that is to put on sort of small right tail and left tail sort of positions for things that we don't really have a lot of exposure to, to not risk a lot of our principal, but to be able to get potentially some protection if something happens. So we have some exposure to uranium and uranium linked securities just
Okay.
because there's a risk that there's a uranium squeeze and prices go parabolic, and we don't want to miss that. But there is an aspect of what you just said that I will sympathize with, which is I just saw this video of a tank getting hit by a train in the U.S. because of an incompetent operator or logistics person who probably was a DEI hire.
Yeah.
And I'm really worried about sort of a degradation of sort of base construction and engineering competency.
Yeah.
And if you think about where that's the highest risk, that's the highest risk on weapon systems and the highest risk on nuclear reactors. And so I
Yeah.
really I get angst around that. And people will say, oh, well, not many people have died from nuclear reactors in history. And I just don't think that's the right way to evaluate that
Yeah.
left risk. Not that many tanks were hit by trains in peacetime in the US, but you can see a tank that got hit by a train. So,
Yeah.
you have to be, I think, a little imaginative. And with these sorts of things, I mean, there's a lot of left tail risk, and people know it and they hate when you talk about it. And I'm sure I'll get a lot of hate mail for this, but it needs to be said. I think we need to reinvigorate our meritocracy in the West, and reinvigorate sort of pay for performance and promotion for performance, and that's the only characteristic that we need to pay and promote for. And I think once we've reinvigorated that, then we should go build a ton of nuclear reactors. But
Yeah.
until then, I think I'd be real hesitant to do things like that where there is this inherent left tail risk. Again, people are going to hate this, but the right way to evaluate it isn't what's happened so far. It's what capacity have we destroyed or introduced risk to in our systems, and how do we mitigate those risks? And one of those is maybe we slow down with nuclear reactors until we stop DEI hires on that sort of construction.
Couldn't agree more, man. I mean, you look at the food processing plant fires. We had the bridge fall down in Baltimore. I don't know about other people, but I'm a little bit more apprehensive to fly these days with the Boeing stuff. But yeah, couldn't agree more. I think that's a good segue into RMP Energy and Iron Bridge. You've had the experience of leading a turnaround and eventual sale of Iron Bridge resources at a really good premium. How did that experience as an operator influence your perspective as an investor? And how do you apply those insights when analyzing energy companies today? I know a lot of listeners here work in the corporate world. I can speak for myself when I say it's fairly obvious when you have incompetence, you have bureaucracy that ends up impacting the bottom line. What were some of the leadership lessons you learned from that?
Yeah, I mean, running companies is really hard. It increased my respect for good managers and good business leaders who are able to balance strategic decisions with tough people decisions and capital decisions. I think it's a really hard balance. I think I have a lot more respect for CEOs and senior leadership, as well as senior people on boards who run really successful companies that are able, don't just do well in an up market, but are able to navigate challenges effectively. One example, the local price for natural gas collapsed after I became chairman
Yeah.
of Iron Bridge. So I think the forward curve for local gas price was like over $3 an MCF, and it fell to like one in that 18-month period. So we had a lot of success in terms of it was a profitable enterprise from when I became chairman in January of 2017 to when we sold the company in September of 2018. We were up about 20% versus the comparable companies in that area, that sort of asset, Montney
Mm.
focused oil and gas producers. The average stock was down around 40 to 50%, and the small caps were down 60 to 70%. And RMP was a small cap. And so it was a very, very difficult time. And it is possible, it's sort of like the story that the father tells in Catch Me If You Can, where there's two mice or whatever rodents that are dropped into two different buckets of milk, and one of them swims for a little while and gives up and drowns, and the other one just swims so hard for so long that it turns into butter or cream or whatever, and is able to actually climb out.
Yeah.
And so I think it's possible to work really, really hard and try to navigate the best you can, and to actually generate a positive outcome, even when you're faced with enormous negative headwinds.
Yeah, absolutely. I know at the time there was, you mentioned, I believe you referenced it in one of the posts that you put out, that there was a brutal turndown in the market. A lot of the peers' share prices were down, I think on average 50%. Do you think that was largely a result of the market at the time, or because they failed to make some of the appropriate changes to acclimate to that market environment?
Yeah, I think it was a combination. It was also a very tough time in Alberta, where they had, for the first time in many years, a left wing provincial government,
Hmm.
which was just catastrophic. I mean, when people say, "Oh, elections don't matter," and then you look at what happens when elections go a certain way, various people were popularly elected, like a Hugo Chavez in
Yeah.
Venezuela, and you fast forward 15 years and there's cannibalism. It's
Yeah.
like, oh man, that election mattered a lot.
Yeah.
So that NDP election mattered a lot in Alberta. They were an unmitigated disaster. They were so bad. They hated oil and gas so much that when we started doing power generation and actually Bitcoin mining, the idea wasn't to become a big Bitcoin miner, but to host it and make a lot of money on gas when we were losing money on it before. And we went to the government and said, "Hey guys, we're going to go build a data center here. You keep talking about like technology jobs and different
Yeah.
jobs. Let's do it. We only need your money. We just need you to like drop some regulatory barriers, help us with some of our contracts, some of our other stuff." And they were like, "Oh, you're an oil company. We hate you." And it's like, what do you mean? Like
Yeah.
we're doing what you said, right? You want these jobs, you want this transition. Here it is, and they
Yeah.
were not interested at all. And so that was really was just they were just communists. They hate everyone and just want people dead. And as far as I can tell, is my interpretation of their response. Like they would rather just have like forest and no people in Alberta, and their policies were sort of in line with that. So elections matter a lot, and the governments matter a lot. And so it's really hard to blame the management teams of these other companies. And also the one other thing in their defense, so RMP had gone from $10 a share to 70 cents a share, and I became chairman and we sold it for 80 something. So it's not like
Wow.
some of these other stocks were down a lot, but maybe not down that much. So there
Sure.
was some catch up there. The flip side is when a stock is down 90%, 95%, that's usually not the right percent for it to be down. Usually it should be down 100%, but then maybe instead of that, it should be down, let's say 70% or 80%. So there's
Yeah.
different, it's not a perfect correlation, but on one hand, the turnaround is important because it wasn't a zero, which could have happened if there wasn't some intervention. But it also wasn't as sort of wonderful as I guess it could have been, because we could have in theory reverted towards the mean of like the 3-year performance or 5-year performance for these stocks. I wasn't involved. I didn't I wasn't chairman of the company. I wasn't controlling it at that time, and
Right.
I owned way more stock once I was in control of it. But it's not. I wasn't saying that to criticize the other management teams. It was just I am proud
Yeah.
of the outperformance while I was there, but there were lots of other factors that led to that underperformance by those other companies.
I appreciate that context. So you also write on Substack. I know you've written extensively on oil and gas investments. In your experience, what are some of the most misunderstood aspects of investing in this sector? And how do you think investors can better navigate it? I'm not necessarily talking about, going out and buying naked calls that expire in a week, but someone that wants to take maybe a medium to longer term approach and acquire some of these names over time.
Yeah, it's a great question. Yeah, so we put out stuff. So we have a monthly note that we've been a little slow on
Sure.
recently, but a monthly note for accredited investors, and then we wanted to keep providing that to non-accredited investors, and found that it was better for compliance reasons to just have a separate list that we provided through Substack that was open to anyone and free. And we also, I had written extensively on Seeking Alpha previously. It was just sort of a helpful
Mhm.
way to share thoughts. And I use Twitter X now similarly to sort of air out different thoughts and get feedback, and
Right.
consider different aspects of investment thesis. I think that's actually one of the most important parts of investing, is being open to and actually seeking contrary information to your thesis, like a Munger-esque, like invert your investment thesis, try to kill it, try to best understand sort of why people don't own a stock or why they hate it. So I think that's important generally. But look, oil and gas is really tough. And many of the folks that know it best, what does they say? Those that know it best like it least.
Yeah.
It's really tough to do well, and it's really tough to outperform relative to the overall market, and it's hard to outperform versus sector indexes. So on one hand, I'm very proud of how well Bison's done versus those indexes. On the other hand, I'm not sure. I think the value approach that we have should lead to outperformance over time, but I can't promise that. And the amount that we outperformed is sort of unusual. The reality is, I think Bogle is right. Like most of the time, most people, whether they're professional managers or individual investors, will underperform the market.
Right.
So I think unless you have some significant edge in the space, and even a number of the people I know that are, executives of private companies or run public companies and then buy other stocks in the sector, I think they all do pretty poorly for the most part. So I would proceed with a lot of caution. It's a very, very difficult game, and most people lose.
Yeah, yeah, it's definitely the Wild West, I think, compared to some other industries. That's helpful though. I think that'll provide some context to some of the listeners. You've also, aside from obviously your role at Bison right now, you've consulted for Fortune 500 companies, you've worked in private equity. How did those experience shape your current investment philosophy, especially when we talk about identifying undervalued opportunities? I've heard you mention before you like strong balance sheets, proven management teams. When we look at some of the ideas you've touched on before, like Journey Energy in Alberta, what are some of your thoughts there?
Yeah, I mean, so you try to do things to stack the odds in your favor in a legal manner, right? So you can't get
Right.
returned on public information, you can't cheat, whatever, but you do what you can, right? So you evaluate the assets, you evaluate the balance sheets, the cash flows of the business, and the track records of the people. And even doing all that, you can still get a
Hmm.
lot wrong. So, I don't really want to get into specific names, but I'd say there have been a few recently that have been very disappointing relative to the people's track records. And so just because someone's
Interesting.
done really well for 10 years or 20 years doesn't mean they're going to do well for the next 10 years or next 2 years or what have you. So I think it's really tough. I'd say so when I was in private equity, working for this lower middle market buyout shop, I had this intern who was brilliant, and I used to love just sitting and talking with him.
Yeah.
And now he's very, very famous, and hundreds of millions, or at least millions of people have like bought his book and listened to his
Wow.
stuff and so on. So we would sit there and talk, and we looked at like Monish Pabrai's investments and his books, and looked at some other folks. And Monish at the time was heavily invested in Harvest Natural Resources, which was a Venezuelan oil company.
Okay.
Traded in the US, technically through like a Benelux structure. So they thought they were protected from expropriation. Guess what? They weren't. And so
Right.
that was a real good, it was real good education in terms of like, these things can go up a lot and then go to zero. And that was, it didn't go to zero while we were there, but we did get to see some craziness around people getting excited about that stock. And then despondency as Venezuela started nationalizing foreign owned oil companies.
Interesting. Yeah, I mean the landscape has shifted drastically. We have all this regime change in Latin America, across the world. I tend to agree with you on your short-term outlook for the Middle East. I think the probability that there's an escalation there is increasing with each passing week, particularly with our elevated presence in the region. What are the major geopolitical risks that investors should be focused on if they're exposed to energy? I know the outlook next year looks to be a bit weaker for oil. There should be a surplus each quarter, depending on what OPEC does. What situations come to mind? I'm kind of exhausted by, this theory that China's going to take Taiwan. People have been harping on that for a while. Interesting. Yeah, I mean the landscape has shifted drastically, right? We have all this regime change in Latin America. I tend to agree with you on your short-term outlook on the Middle East. I think that the risk of escalation is growing with each passing week, particularly with our elevated presence in the region. What are the major geopolitical risks that investors should be focused on if they're exposed to energy? I know the outlook next year looks to be weaker for oil. There should be a surplus each quarter depending on what OPEC does. What comes to mind? I'm a bit exhausted by this theory that China's going to move on Taiwan. I'm sure it'll happen at some point. Media has been harping on it endlessly, but more immediately, what are your thoughts?
I don't see why China would move on Taiwan. I don't know as much about this as the Middle East at all.
Sure.
But I just don't, again, you just look at the incentives, like China's winning. Why do
Yeah.
they need, at least relative to the Taiwan situation, why do they need to do anything? They just act threatening, they get all their people excited. And then, I mean, if anything, if they moved on Taiwan, it would reduce this thing. You think about like 1984, where there's the other people that you get the population angry at and excited about. Taiwan is that to some extent for China, and they're way less dangerous than getting everyone angry at the US or some other sort of big adversary, because Taiwan's not going to do anything about it as long as China doesn't invade. So honestly, I just see the super high level. The incentives seem there for China just to keep getting mad, keep pushing the envelope, and do nothing substantive, and not invade Taiwan. I would be really surprised. Again, just using that pure incentive theory lens. I mean, I think the Middle East conflict, I think it's not anywhere close to over. I think there's a lot of wishful thinking. There's a lot of like weird sort of fifth column type stuff going on in the US right now, where there's folks who are proven to be spies for various foreign countries that are senior advisors or staff members for the presidential administration, for one of the candidates to become president, for various senators and congress people. I mean, it's very weird and concerning, because I think a lot of the narrative that we're being fed on what's happening in the Middle East and what might happen, right? All these people are so obsessed with, oh, Netanyahu's evil and he's going to get kicked out right away, or we're going to force a ceasefire between Israel and a terrorist group, like after the terrorist group killed 1,200 Israelis. Israel says no. The majority of the people there poll against that. I mean, there's only so much wishful thinking by folks that are, in some cases, led by Iranian affiliates or Chinese affiliates or spies. People are proven to be. I just think it's sort of weird how that narrative has been set, and I think the expectations for that to calm down are way too high, and the odds of that escalating are too high. And then to your point about Ukraine and Russia, I mean, my biggest concern there, look, it's a horrible humanitarian catastrophe that Russia invaded Ukraine. They should not have done it. It's terrible, it's evil, and wrongly should not have done it. But I think the bigger concern, I think from a utilitarian perspective, is that conflict spreads and there's this risk of nuclear war. And there's a reason why, as a world, we were obsessed with nuclear war for 50 years or 40 years or whatever. I mean, it's horrible, and it's potentially how we become extinct. And so let's not have nuclear war, and whatever we need to do to avoid nuclear war and to avoid sort of the majority of the population in like concentration camp equivalents, let's do what we can to avoid those things. And like you're saying, I think there's an unacceptably high risk. It's still low, but an unacceptably high risk of World War III. And I actually don't think the Middle East spiraling is likely to trigger a World War III. I don't think anyone really cares enough to escalate around that. Like, no offense. And again, like, I'm sort of more affiliated with Israel than Iran or whatever, but like, I don't think anyone cares enough to really do it. But people care a lot in Europe about, if the conflict spreads to Poland or Latvia, or if Ukraine keeps bombing using European or American weapons, Moscow, various other places. I think there's a real risk, and I think that's very scary. That's not oil specific, because the West has decided to continue to buy Russian oil and to not cut off. It's bizarre that for a while there were oil and gas that were flowing from Russia through Ukraine during this war, where Ukraine's like going and getting money from the US and Europe for their defense, while allowing the transport, in some cases buying Russian oil. That was actually really educational for me. It turned out that Zelensky was sort of affiliated with this oil trading group that was buying Russian oil, shipping it through Ukraine and selling it to Western Europe. And I posted something about that on Twitter because I thought it was crazy. And it was apparently true. Like, it was validated by multiple different sources. Folks I know in the oil physical trading world were talking about it and complaining about it. And people got so mad at me. And it's like, what do you mean? Like, I'm not doing it. I'm not in favor of it. I think it's wild that Ukraine, the people running Ukraine, are profiteering off of Russian oil. But anyway, my point is that World War III concern, it's not energy driven. It's not like I'm going to make more money or less money. It's just an unacceptable left tail risk. And I think we should be, I think we want to be really careful to not be partisan about any of that, and just to be very focused on, in any way that we can, advocating against an escalation that could lead to nuclear war and sort of humanity ended.
Agreed. I mean, you've seen this sort of creeping line where the Ukrainians are now moving into the Kursk region. This is the first time they've actually pushed into Russia. I'm not necessarily sure what their end goal is with that move. They're not going to obviously occupy Russia for any substantial amount of time. And then, of course, you have the component of U.S. support indirectly, but increasingly more directly with arms and equipment that they're providing. The latest being the missiles that might be used to strike deep inside Russia, which just elevates potential calamity. To your earlier point, New York Governor Kathy Hochul, her ex aide, just 2 weeks ago was arrested for being a Chinese spy. And some days I'm not sure, man. It seems like people care more about the weather or what Taylor Swift is saying than those things, which could have devastating impacts for all of us. Finally, I just wanted to ask, what advice would you give to younger investors, people that are looking to break potentially into the energy or deep value investing space, especially with the global energy transition underway?
Oh man, I mean, it's really tough. Most people I talk to who are interested in going and starting their own investment firm, I tell them not to do it. It's so hard. There are enormous. I mean, as the U.S. has gotten sort of more regulated and less of sort of a free market economy, there are enormous barriers to entry in regulated businesses, and
Mhm.
finance and securities are among the most regulated out of any business. So being an entrepreneur in a highly regulated business is crushing. And we've done really well at Bison, and it's still just absolutely crushing. No one wants to invest in a small firm. No one wants to deal with a small firm. No, it's just crushing. It's set up in such a way that BlackRock and top 10 hedge funds or whatever win.
Yeah.
Pay a lot for back office and lawyers and stuff, and everyone else loses. So it's a very, very difficult space to be an entrepreneur in. That being said, there are extraordinary returns available if you're able to be competitive in that sort of environment. And so it's
Mhm.
not really set up for that, and there's lots of ways to lose. But there's a number of different folks I know who have done really well. I think the challenge is to make sure that whatever your investment process is, that it can deliver material outperformance over time, which is really the product that you deliver as an investment manager. And then to get into it as an employee, like to go work as an analyst or in investment banking or various other stuff within the finance world in oil and gas, or in energy. Yeah, I think it's an interesting space to work. I think you have to really care a lot about it, and I think there's a lot of other places to go that might be easier. But that being said, if you look at sort of what your returns were for being an oil and gas investment banker in like 2005 versus being a tech investment banker or whatever, like there were a few years where you did way better in oil and gas. One of my friends, he got into it in, I think it was 2007, 2008, and just there weren't jobs in tech banking, but there were in oil and gas, and
Yeah.
so there's cyclical aspects to that as well. But yeah, I think I would generally advise people not to start small investment funds, particularly on the public side. And then if you're going to go work for one or so on, I think you want to just do the best you can, whatever job you're in, and whatever you need to do to lead up to be sort of the most competitive. And then the sort of it's crazy, especially in the context of the really tragic death of that Citibank
Yeah.
investment banking analyst. But it's like so competitive that in order to be successful in that sort of role, you really have to lean in and work the crazy hours that they tell you don't have to, but to be successful, you sort of do. So it's really, I think it's just it's a very tough industry. But if you love it and you can't not do it, I mean, like for me, I've been investing as a value investor since I was 13. Like I've been reading the Motley Fool column since I was like 9. So I don't know. I can't really see myself doing anything else. I love it so much. And even when I hate it, I hide under my desk and click buy and read more about oil and gas stocks and other potential investments and try to better understand these businesses. So I think if you love it, it's a great place to be. But if you don't love it, there's so many other ways to make money and to get through life that probably better greener pastures elsewhere.
That's great advice. Well, look, Josh, This has been an incredible conversation, a lot of good insights. I enjoyed talking, hearing your perspective. I know a lot of our listeners probably learned quite a bit today. Appreciate you joining Risk On.
Absolutely. Thank you very much for having me. And thanks for all the stuff you do on your various social media and other platforms.
Appreciate that. To our listeners, don't forget to tune in to Risk On next week for more in depth discussion on financial markets, geopolitics, and the forces shaping the global economy. If you can, drop us a review on Spotify to help with the algo. I'll link Josh's Twitter and Substack in the episode bio for those of you interested in following him more directly. Until next time, stay sharp and take care.